Okay, let's dive into this. Welcome to The Explainer. Today we are unpacking an absolutely massive tectonic shift in the global financial system. And the crazy part? It's hiding right in plain sight. We're talking about de-dollarization, the subtle reindustrialization of superpowers, and a very specific macroeconomic theory that calculates the future price of gold at, wait for it, a staggering $38,000 per ounce. I know it sounds totally wild. But as you'll see, when we actually look at the data, the historical precedents, and the exact moves central banks are making literally right now, all these puzzle pieces start to fit together perfectly. So to really understand this shift, we actually need to start our journey in China. $13 billion. That staggering number represents the current size of the Guan Yu Gold ETF. Yep, it has recently become the absolute largest chunk of retail investor money that ordinary Chinese citizens are just pouring their capital into. And this highlights a massive, massive anomaly. Think about this. This $13 billion gold fund has actually surpassed China's S&P 500 equivalent, which sits at around $12 billion. Just pause and think about that for a second. In the second biggest economy in the entire world, the largest pool of retail investor capital isn't going into their primary stock market index. Nope, it is pouring directly into physical gold. Which naturally brings us to the big mystery, right? Why on earth would you buy gold when prices are crashing? Earlier this year, gold dropped nearly 30% from its recent peak, falling from around $5,600 an ounce down to below $4,000. But here's the kicker. As the price absolutely plummeted, the People's Bank of China just kept buying it for 20 straight months. That is their longest streak since at least 2015. And hey, it's not just China. Central banks all over the globe, from Poland to Kazakhstan, are buying at a record-breaking pace. They aren't trying to time some market dip for a quick buck. They are systematically accumulating an asset. So, why? Section 1. The Blueprint of Empires and the Fall of Industry. Let's move to and see how this builds across history. Recently, U.S. Treasury Secretary Scott Bessent published an op-ed advocating for a return to what he called Hamiltonian economics. So, back in 1791, Alexander Hamilton rolled out a protective plan. We're talking high tariffs and subsidies. The U.S. used this exact blueprint to transform from a nation of farmers into a total industrial titan. But watch this pattern, it's fascinating. Empires rise by protecting their infant industries, right? But once they dominate, they completely flip the script and start preaching free trade. Britain did exactly this in 1846. They deindustrialized. And by 1931, they yielded global leadership right over to the U.S. Fast forward to 1971, the U.S. exits the gold standard, kicking off its very own era of deindustrialization. The primary driver behind this decline? It's a process called securitization. Basically, this is what happens when a country stops making actual, real things and instead starts making its money by just shuffling paper and financial products around. It completely hollows out a nation's industrial base. Sure, the empire gets incredibly rich on paper with this kind of funny money, but they become dangerously exposed in the real world because, well, they literally no longer have the capacity to manufacture what they actually need to survive. And honestly, we all feel the brutal effects of this securitization today. The U.S. basically traded away its high-paying industrial jobs to offshore manufacturing, and in return, what do we get? Incredibly cheap consumer goods. Televisions are down a staggering 98%, toys down 74%, software is cheaper too. But look at the other side of the ledger. The essential pillars of a stable life, the things you absolutely cannot just ship over from overseas, like housing, childcare, hospital services. The costs have absolutely skyrocketed. We traded our long-term industrial stability for cheap flat-screen TVs and ended up with a cost of living that is just entirely unaffordable for Main Street. Section 2. America's Impossible Economic Triangle. So current U.S. economic statecraft is desperately trying to hit Command-Z on the keyboard and somehow undo this multi-decade deindustrialization. Based on some absolutely brilliant analysis by macro researcher Luke Groman, policymakers essentially have three major goals on their whiteboard right now. Number 1, rebuild American factories to secure our national capacity. Number 2, protect Main Street by keeping the cost of living and inflation low. And number 3, maintain a strong U.S. dollar to preserve global financial leadership. But here is the absolutely crucial point to understand. You can only pick two, and you have to sacrifice one. These three goals represent a massive systemic contradiction. Think about it. If you keep the dollar strong, American factories stay way too expensive and completely uncompetitive globally. But if you try to force those factories back while still keeping the dollar strong, well, you have to enact massive protective tariffs. And what happens then? that immediately spikes inflation and crushes Main Street. Mathematically speaking, one of these three pillars literally has to fall. Section 3. The search for a neutral reserve asset. Because of this impossible triangle, the growing consensus among macroeconomic analysts is that policymakers might quietly be preparing to sacrifice the overvalued US dollar. But doing that requires a massive global escape valve to absorb the shock. China has actually seen this coming for a long time. Back in March 2009, right after the US printed trillions of dollars to save the Western financial system, the governor of China's central bank published a paper demanding a new international reserve currency. They realized, hey, our entire national savings account is held in the depreciating IOUs of another country. And in a brilliant bit of irony, China actually quoted the famous Western capitalist economist John Maynard Keynes to make their point. And the thing is, China wasn't alone in this thinking. Top economic minds globally have been signaling this exact need for years. Keynes himself proposed a neutral asset called the bancor back in the 1940s to balance global trade. China echoed that exact sentiment in 2009. World Bank President Robert Zoellick suggested gold as a reference point in 2010. And former IMF chief economist Ken Ragoff argued in 2016 that emerging markets should hold gold for one very specific reason. Despite its nearly fixed supply, there is absolutely no limit on its price. Now, what's really interesting about this slide is the action happening right now, behind the scenes. We're looking at U.S. non-monetary gold exports to China. Look at that massive, totally unprecedented spike starting in the fourth quarter of 2023. The United States is quite literally shipping record amounts of physical gold over to China as we speak. The global rotation into this neutral asset is already well underway. Section 4. The math behind $38,000 gold. Okay, so let's put our detective hats on for a second. If gold really is the chosen escape valve, what does the price actually need to be for the global math to work? The equation that analysts like Grauman use is surprisingly straightforward. Step 1, you take China's current trade surplus, which sits at roughly $1.2 trillion. Step 2, you measure China's recent annual gold imports, which are roughly 940 tons. Finally, step 3, you just divide that trade surplus by the amount of physical gold they are bringing in. That tells you the price required to settle that surplus purely in gold. And when you run those numbers, that calculation lands you right here, $38,000 per ounce. It's wild, but at today's prices, gold is simply far too cheap to act as the settlement layer for world trade. There literally isn't enough of it, at its current valuation, to balance the global books. But at $38,000 an ounce, the global macroeconomic math balances out perfectly. So how does this all play out in the real world? Well, there are essentially two paths forward. Path A is a messy, chaotic paper system collapse, kind of similar to the economic turmoil we saw in the 1920s and 30s, where fiat currencies just crack under the immense pressure of unpayable debt. Then you have Path B, which is a controlled, managed transition, where the U.S. successfully reindustrializes, global trade is rebalanced, and the world adopts a neutral reserve asset collaboratively. But notice the key takeaway here. Whether the road ahead is messy or managed, both paths ultimately lead to a massive repricing of real, hard assets. In fact, we can already see this repricing happening right now if we just change our measuring stick. Since the first trade wars kicked off in 2018, the S&P 500 looks absolutely incredible on paper. It's up 161% in US dollars. But if you measure that exact same performance in gold, the S&P is actually down 15%. Long-term treasuries, traditionally considered the safest asset on Earth, are down 31% in dollars and absolutely crushed by 78% when measured in gold. The illusion of paper wealth starts fading fast when you measure it against uninflatable, real money. But look, as focused learners, we really have to keep our heads on straight here. This explainer is all about understanding deep macroeconomic tectonic shifts. This is a decade-long transition. It is absolutely not a signal to rush into hasty, short-term trades out of FOMO. Remember, accumulation by nation-states moves at a glacial pace. There will definitely be major market corrections along the way. Being right on the overall direction is very, very different from being right on the exact timing. So, as we wrap up this explainer, I want to leave you with this thought to chew on. We are witnessing the end of a 50-year economic operating system, and the smartest central banks in the world are aggressively rotating their wealth as we speak. So you really have to ask yourself, when the global paper systems finally reset and the dust settles, will your portfolio be holding funny money or real assets? Thanks so much for joining me to unpack this, and I'll catch you on the next explainer.